Good afternoon and welcome to BizTech's Asian Midday Market Watch. I'm Brian Fernandez, and let's start by taking a look at market action this morning. Now, most Asian stocks fell today, with losses concentrating around Taiwan and China after US Republican presidential candidate Donald Trump said that Taiwan should pay the US for defense. Still, broader losses were limited to by a strong lead-in from Wall Street, where DJI surged nearly 2% to record highs over optimism of lower interest rates, which saw traders pivot into more economically sensitive sectors and out of technology. Now, in an interview with Bloomberg's Business Week, Trump said that he believed that Taiwan should pay the US for supplying the island with defense equipment on the grounds that Taiwan does not give the US anything. Now, concerns over a Trump presidency has also rattled Chinese markets in recent sessions. Now, given that the former president has maintained a strong rhetoric against the country when he was last president. Now, Chinese markets were also nursing losses from a swathe of weak economic readings from the country. Major chip-making stocks were also on edge, with TSMC falling 2% following Trump's comments. Now, over in Australia, the ASX 200 reached a record high, with the index gaining 0.84% to surpass the previous record of 8,037.30, as gold miners Northern Star Resources and Bellevue Gold rose more than 4.55 and almost 4% respectively. Now, over in Japan, the Reuters Tankan survey showed an increase in business optimism among large Japanese manufacturers, while confidence among non-manufacturers fell. Now, over in Singapore's non-oil domestic exports dropped more than expected in June, now making a fifth straight month of declines. They fell 8.7% year-on-year compared to a 1.2% expected by economists polled by Reuters. Now, to give further insights and analysis into markets, let's welcome our guest for today, Zhong Liang, Zhong Liang. He's the investment analyst and chief investment officer at Standard Chartered Bank. Zhong Liang, welcome to the show.
Happy to be back here, Brian.
Now, Zhong Liang, for a start, we've had a huge U.S. equity rally that has continued into this week, record high yesterday. What are your thoughts on U.S. markets?
Indeed, right? I think S&P 500 posted this 38 record high this year, right? And not only that, I think another observation that I'm seeing is that we are seeing a broadening out of the rally. So if you look at the last 5 sessions, Russell 2000 that gained more than 10%, right? Whereas on the other hand, you have the S&P 500, which has been outperforming a small cap for the entirety of this year. It's only up 1.5% over the stretch. So we are seeing that broadening out, the catch up of that the small cap and other sectors as well. And a large part of the recent strength that we have seen in U.S. equity can be attributed to the solidification of the rate cut expectations, and that's really mainly driven by the softening June inflation data, and also the very dovish Fed speak, right, especially from Powell. So in our view, while this sort of early Fed rate cuts could help the economy achieve a soft landing, we wouldn't really chase the equity rally at this stage. And the main reason is because we are seeing increasingly stretched positioning, right? Not just for the US equity sector, but also for the technology sector, which is the main driver, right, for the equity rally this year. Instead, we would just prefer to wait for more confirmation from the Q2 corporate earnings, which appears to start sort of on the right foot this week. So we got the bank earnings, and most of the major banks seems to be expectation this week as well. We would like to just see a little bit more confirmation from other sectors as we progress through this earnings season. And also, right, the other key piece that we would like to see is a broadening out, right, of the US earnings as well. And I think this ties back to the point that I raised earlier, which I mentioned earlier on, which is the broadening out of the US stock rally, right? If we'll need that broadening out of the US earnings outside of the usual sectors in order for the broadening out of the stock rally to actually sustain.
Zhong Liang, what is the House view then on the Trump effect around markets as we move into the November election?
Yes, I think the different headlines, right, that we are going to see from now on till November, that's definitely going to bring bulk of volatility, right? And as we have seen, right, yesterday, the headline surrounding Taiwan, right, coming out from Trump, that has dragged the Taiwan benchmark down this morning, right? And I think similar headlines like this coming out from either side of the either candidates that could bring some volatility around it. But I think based on analysis, right, if we look longer term, typically, right, once we get the final conclusion in November, equities would actually typically trend up, right? Again, we could get different sort of the uptrend depending on which candidate we get eventually. And as you mentioned, right, Trump seems to be sort of the leading candidate right now. If we do get a Trump 2.0, it's very likely the U.S. equity is going to outperform other regions, and other regions are going to be sort of suffering, right, because of the different protectionist measures that Trump typically puts up. And he's a little bit more pro-America, pro-corporate, and those are typically much better for U.S. Corporates.
Okay, I want to take a look now at China. So a lot of things happening in China right now, but I want to start with then the data that's come out. Data's not been great. Zhong Liang, your views on the data out of China?
Yeah, I would agree with you, right? On balance, if you look at the recent trough of data, that is relatively soft, right? And the only bright spot is really the resilient exports, right? If I could just bring you through, I guess, some data that we are paying close attention to. If you look at imports that was released last Friday, came in lower than expected. In fact, expectation was expecting for a climb of about 2.5%, it contracted 2.3%, right? That to me signals very weak domestic consumption. Other data, right, that came through start of this week were also sort of showing a very similar story, similar picture. Retail sales released on Monday, it rose less than expected by 2%, right? And it was the slowest monthly pace since the end of 2022. And the weak retail sales is also quite evident. It's also one of the main drivers behind the soft GDP print, right, in Q2 as well. Came in at 4.7, lower than expected, what markets were expecting at 5.1. Of course, some could argue that, factory outputs and your non-property investment, fixed asset investment, those came in better than expected. But I would argue that, if you compare on a month-on-month basis, it's still a slowdown from May's data. So, if you couple that with, on a more forward-looking basis, credit growth slowed to 8.1%, right? Slowest on record. That signals to me, right, going forward, the household and corporate loans is going to continue to remain subdued. And it doesn't bode well for the economy, right, from a forward-looking perspective. So I think when we look at this data in entirety, what it means that, especially now we're in the midst of, the Third Plenum, right, the 4-day Third Plenum meetings, I think that piles pressure, right, on the policymakers to actually unleash more supportive measures. And yeah, our expectation is that they're going to do that.
Yeah, so then speaking of policymakers, then what are the impact of the recent changes to the recent PBoC monetary policy framework?
Yeah, so basically what they did was they announce to the markets that they're gonna borrow government bonds from primary makers, and they're gonna sell in the public markets. And I think the whole purpose of that is because they are trying to sort of clamp down on the recent upsurge in China government bonds, right? The prices have been soaring of late, have been outperforming. And they are afraid that it goes out of control, so they're trying to, as per usual, right? Chinese government likes to clamp down on speculation, so that's what exactly they're trying to do there. So and in fact, other changes that they have introduced is also the introduce of overnight repo, reverse repo rates, and the sort of short-term policy rates. And if you look at the headline level, it looks like these measures. It looks like a version, right, of QT, right? They're trying to raise interest rate. But in our view, right, we do think that the recent surge in the onshore yields, those are temporary, right? We feel that what the Chinese government are doing is more of trying to enhance the availability of short-term monetary tools rather than trying to tighten liquidity, right? I think the other point which I touched on earlier on is they're trying to sort of bring down to clamp down the speculative actions that are.
And I think Zhong Liang, that's a really good point, because again, and again, looking at it through different lens, and you look at it historically, it's all about dampening speculation more than anything else. That's their primary concern.
Exactly. And I think we've seen similar moves that in the Chinese equity markets as well historically, right? When the upsurge has gone far beyond fundamentals, they try to come in and try to clamp down on it. So I think similarly, right, within the China government bond markets, that is what they're trying to do now.
Zhong Liang, thank you very much for coming in. Thanks for your insights.
Happy to be here. Thanks.
Now, we've been speaking to Zhong Liang. He's the investment strategist, chief investment officer at Standard Chartered Bank. This has been BizTech's Asian Midday Market Watch. Be sure to keep informed on the latest market updates weekdays at 1 p.m. Singapore time. I'm Brian Fernandez. Check out the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, third-party websites, and trading apps. Thanks a lot for tuning in.